You've been traveling all around the world. Tell us what you're seeing on the ground when you're worried about these signs of distress.
Well, January, there was a lot of exuberance because there were surprises. China's earlier than expected reopening, a thought, like, are we getting close to the Fed pause? Now, come February, we've seen a reversal of a lot of this sentiment. And I think the question that we're getting is, where's the terminal rate going to peak? Are central banks going to have to do more? The Fed, the ECB, Bank of England, we've made more upward revisions for what they need to do. And then there's been some disappointment on the China reopening. There was this initial exuberance, particularly in commodity markets. And now the question is, how much will come out of these twin sessions that are underway? Are we going to see any bigger announcements? And there's really not the scope to do a lot of QE. Now, I still think you're going to have a big recovery in China's growth, going to 5.5%. But I think that some of the spillover that everybody thought would sort of boost overall emerging markets, hasn't played out as much because this is much more about domestic consumption and services. It's not the usual kind of boom that we've seen when China has had a recovery in growth.
And it's really interesting because even if you look at, say, currencies in emerging markets, Asia, for example, they've been underperforming broader EMs, as this chart on the Bloomberg shows. So why aren't we seeing really that lift when it comes to even currencies and other assets in Asia that you would think are more susceptible and exposed to China?
I think that, look, the consumption and services part is much more of a domestic phenomena. And so when we've had recoveries in China before, it's often been on the export investment side of it that's led. But that's not the case this time. I mean, this is a trend that China has been focusing on to go back to more domestic consumption, domestic drivers of growth. And I think that some of the expectations for what the government could announce were probably too exuberant as well. So we do think that you're going to see out of these twin sessions that are underway, like, some things on the framework, the longer term framework that will improve, but it's probably less than what the market had hoped for. So some of that exuberance has faded as we're ending the month of February, but more broadly, we are still looking at that it's much too early to say that the tightening cycle is over. Nobody is talking about an ease in the second half of the year, and that was all the talk back in January.
You're right when it comes to about domestic priorities, right? Whatever we get out of these sessions, out of the National People's Congress, it will be focused on those domestic drivers for growth. Is it possible to gauge what they could be and how you invest along those lines? Because obviously you want to be on the right side of policy when it comes to investing in China.
Well, look, I still think that there's going to be a recovery in travel and tourism. There's still a lot of pent-up demand, but it is something where 3 to 5.5% growth. I mean, that's 250 basis points. So I wouldn't downplay that there's still momentum here to go. But some of the focus that's been on the property sector. Could there be more measures that are forthcoming, or on household income? That's where I think that you could see some disappointment. So it's still the more domestic sectors that are going to benefit here. But I think that some of the exuberance on the commodity side, that's where I think you've seen some disappointment that everybody has sort of looked at the past cycles, the past memories of how these recoveries had played out. And this is really different because it is much more on services and on the domestic consumption.
When it comes to the inflationary picture, are you a buyer into the idea that we are going to see another round of inflation globally be unleashed as a result of the China reopening? Is it going to be more nuanced than that?
Well, look, I mean, China was not synchronized with the rest of the inflation cycle around the globe. I mean, you actually had deflation in the PPI, in the fourth quarter of the year. So I'm not so worried about the high inflation in China. But overall, I mean, what you're seeing is, the move in core inflation globally. This is where we've just seen a broader move that's taking hold with respect to the forecasts that we're doing for the developed country, central banks across the board, whether it is the Fed, the ECB, or the Bank of England. So I think that in China itself, we're still looking at, 2%. Are you going to end at 3%? But I think in other parts of the world, this is where we've had, more inflation surprises. We've seen only partial disinflation. And that's really what the key question is right now. Where will the terminal rate need to the peak.
Joyce, are we taking all of these geopolitical risks, whether it's U.S.-China, whether it's a continuing war in Ukraine, as the new normal? Are we just being too complacent about those risks?
I think there is some complacency that has set in, because everybody has kind of gotten used to watching this. And a year after the war in Ukraine, who would have thought that you'd actually have that oil prices would be lower? But I do think you're going to see still attention focused on U.S.-China tensions. This is the first night of the Select Committee tonight, in the U.S. Congress. Could you see more export restrictions, some investment restrictions, or some more sanctions on individual companies, which is what we've been seeing rolled out? But some of the bigger picture things like Taiwan, I think there's actually more caution on actually doing something this year, in part because doing something in the run-up to the January 2024 elections, that may not be as eventful as a lot of people had feared a few months ago.